Let's get some thoughts on the market. Joining us now is David Pearce, who is Director of Strategic Initiatives at GPS Capital Markets. David, we've had another interesting week on markets. It feels as though we've lost some of that leadership to the upside from banks that have been really stepping up to replace the trade around technology. But as we've seen a slight reversal there across the board, it has meant the market indices have also dropped. What do you make of the direction from here?
Well, that's rough because it seems like there's 10 things going one way and 10 another. And right now, I think we really have to go back to where interest rates are going, and everybody believes that interest rates have to go up due to the economy right now and how hot the economy is. Interest rates going up are going to drive things a couple of different directions. We've got a great underlying business economy, but when we look at some of the stock prices, a lot of things look to be overblown. Yet, if we saw some rate cuts in China, but where we expect to have rate increases in the United States, I expect to see more money flowing into the U.S. markets, which should bode well over the longer term for the Dow and the Nasdaq. So I do expect to see some strength in the U.S. markets. From the bank side, I think that's going to be a little bit rougher. I think there's going to be more pressure on them to compete for the money that's out there. We've seen a lot of financial institutions go out and issue bonds to try to raise money while the rates are cheap right now. But I think there's going to be increased demand for markets, for who they're going to lend money to right now.
And David, a couple of points there. I think it's telling that you can't really pick the short-term direction for markets. That's in contrast to just about every market participant and manager being able to call the market going higher for so long. So that is quite a departure from that type of sentiment. But also when it comes to the banks, I just wanted to test the waters on what the loan growth, mortgage side, demand side will look like, because that is where the market is saying there'll be a pickup as we see an interest rate recovery story taking place. But, the home builders fell stateside yesterday, and I think here there were some concerns in the market too that higher rates could actually crimp off some of the demand. What's the tipping point? If this time is a little bit different to last time, what's the tipping point on rates hitting consumers and businesses?
Well, it's really a couple of factors. It's not just the rates going up. We have seen a tremendous increase in the price of homes, both the new home construction as well as existing homes. So, where I'm at, we've seen home prices increase about 30% in the last year. So if you have a 30% increase in the price of homes and then you have interest rate increases, it's pricing a lot more people out of the market. Granted, there still is lots of demand, but I expect to see, as we see increased interest rates, we're going to have to get some reduction in price on the real estate side. There's just so much capacity that people have to be able to pay higher interest rates and pay higher prices for their homes.
David, there's a mismatch, though, isn't there, here between the analysts taking their red pens to the home builders and the data that we're getting from the market itself. Those December numbers yesterday on starts and permits were very strong, and yet it was a day where, as Karen pointed out, the home builders fell because the analysts decided that they have already reached their stop prices at this stage. So this represents opportunity because the market has a different view to the data. Which comes right in the end?
Well, I think that if you look at the real estate market over history, we have seen when there is tremendous demand, the home builders tend to go all in, because they're making lots of money. And then when we see a crash, the crash is tremendous. So I think that right now, the lag time between home starts and finishing homes, you're talking a year and a half there, and there's a lot of people still, as they're investing and getting their property developed, it could be 2, 3, 4 years before they actually have a completed product to sell. And if you look down the road 2 or 3 years and have significantly higher interest rates, I think that it's going to be really difficult to fulfill the demand for the homes. I think the home builders are going to have a hard time selling the product that they've got several years down the road. So when we see a reset in the value of the real estate stocks, I see that as realistically looking forward.
And just on the tech stocks, do you think the selling continues from here on in? I mean, we've got this marker. We're in correction territory again on the NASDAQ, but it's been pretty difficult to write this market off, and there's been a lot of buying on dips. Are we done here on that kind of buying? What is your prognosis of what happens for technology through the rest of the year?
Well, just go out and try to buy something. If you go to the stores and you go try to buy things right now, there is so much more demand than there is supply. So I think that in the marketplace, whether it's software, hardware, there's still a tremendous amount of demand. And if you look at the unemployment rates, the economy is hard right now for companies to find employees. And I mean, ourselves included. I mean, we are trying desperately to find more employees because we have got a lot of work, we've got a lot of demand, and we've got a lot of things we want to accomplish, but it's hard to find employees right now. So I know there's a lot of stuff going on in the market, and we got interest rates going up, but right now, all the economic signs look really good. Do I think that stocks were probably a little overblown? Yeah, but that doesn't mean that there's not some more value to come back.
Can I pick up on that point around wages? Because we heard from Morgan Stanley CEO James Gorman yesterday pointing out that their structure is effectively a grid and people get paid based on bonuses more than wages, which protects them from the shock of any wage pressure coming through the system. What does that mean more broadly? Because it's not the only company where you're seeing the ability to sort of manage the storm when it comes to inflation pressures. We already know we're in a stock pickers market. Do you think we're going to see more rewards for these companies that are immune to the inflation pressures versus others that are being hit hard?
Well, I think that you've got to really think about what that means to be immune to the inflation pressures. If you are looking at your existing employee base, yes, if they are highly incentivized, it is probably a lot easier to keep the percentages and the ratios in line. If you're going out and trying to attract new talent, that's a whole different story because you're going to have to, pay bonuses or, fees to get those people, and there's going to be a lot more upfront costs than there used to be just to attract the new employees. So if you're in a growing business, I think that the cost structure is different than if you're just in an existing business and you're maintaining. Now, if you go and look at the market that they're in and you're looking at, mergers and acquisitions, and you're looking at, just the private equity or public equity type markets, that is easier to grow that business without tremendously increasing your footprint as far as number of people. But if you're growing, especially on a global basis, we've got offices all over the world, and we talk to people in companies, whether it's Europe or Asia, and everyone is saying the same thing. They are struggling to find employees right now. Their markets are really good. And this is all driving wages up. You can't have increased inflation without having increased costs. You might be able to do that for the next year or 6 months, but there's going to come a point in time where somebody's going to take your employees because they're willing to pay them more because because the market has changed.
David, we've got to say goodbye to you, but thanks for the analysis this morning. David Pierce, Director of Strategic Initiatives at GPS Capital Markets.